Live. It's time now for the big picture. Let's welcome in Kevin Gordon, Senior Investment Strategist over at Charles Schwab. Good morning to you, Kevin. Thank you so much for joining us. You make the argument that the stock market is the next big economic driver. Talk us through that.
Yeah, so the data that we got through the second quarter of the year from the Fed just shows that when you look at household exposure, U.S. household exposure to financial assets, and in particular the stock market, it reached a record high. And it's been more of a feature, I would say, in the post-pandemic era, not necessarily a bug where you've had this exposure hovering near all-time highs. So the move to a record is not necessarily this exponential move. It's incrementally higher than prior peaks that we've seen. But it I think is in keeping with what we've seen a lot in terms of this wealth creation and the wealth effect becoming a lot larger in the post-pandemic world, where probably and arguably you could make the case that the economic driver comes via the stock market because of that wealth effect. If you have stocks that go down, that transfers through the via the wealth effect, then you probably had presumably lower spending. And I think it's exacerbated now because you are seeing a pretty significant split between the upper end and the lower end. And I know this has been talked about a lot among strategists and economists, but it is being exacerbated a lot just because of how well asset markets have done. And when you look at something like GDP growth holding up relatively well, but non-farm payroll growth, really decelerating sharply, there has been a disproportionate hit down the wage and down the wealth spectrum.
What are the risks that you're looking at right now? I mean, what is some of the big questions that are coming from the market, from the people that you speak to with regards to what we're seeing here? Because we continue to scale these record highs, but there are concerns about concentration risk. There are concerns about valuations being stretched. There's conversations about AI bubbles. I'm just wondering how you and your team are assessing all those ideas right now.
Yeah, I mean, certainly all of the events that I've done with our clients and our investors over the past month, concentration risk and valuation has been the first, if not second question that has come up always. And I think there are times when obviously it looks concerning when you think about the fact that the 10 largest names in the S&P 500 make up 40% of the index. That in and of itself looks to be concerning. You can add the overlay, and I think some of the optimistic angle being that when you look at the companies that are make up such a large portion of the index, they do have relatively solid fundamentals. This is not just price performance completely dominating earnings performance. So I think that there is a fundamental story there. But that being said, if you are an investor who's looking at a cap-weighted index or investing that way, you have to be mindful of the risk that's associated with that. Of course, riding the upside of it is great, but when you have a bear market and when those names sometimes underperform the S&P 500 in a bear market, that's when you tend to see sharper drawdowns and what tends to hurt a lot more. So this is really just about reassessing diversification risk and where there might be opportunities to trim and to add, especially for the latter, adding to areas that may have not done as well, but still look relatively solid on a fundamental basis and may not be as large a part of the index. And I think that there are certain sectors that definitely screen well in that area, whether it's financials, whether it's utilities. A lot of them have had relatively strong fundamentals, but they just don't get a lot of attention or as much attention as the tech or tech-related parts of the market are concerned.
We're focused on a lot of Fed speak this week, Kevin, as I'm sure you and your team are passing over some of the commentary, getting some comments out from Bowman this morning, talking about how they've made the first step to bring the federal funds rate back to its neutral level. She's also, acknowledging that it's been a resilient economy, but still worried about the fact that the labour market is showing weakness. And should these conditions continue, concerned that we will need to adjust policy at a faster pace and a larger degree moving forward, which sounds a little bit dovish, I would say, but it's not all been so dovish from the likes of Musalem and also Bostic as well, who's basically said, well, we've had the cut, let's not rush into things, which is obviously different to Myron, which we all know. So how are you putting all of this together as far as, a divided Fed as we await Powell's commentary?
Yeah, I mean, I think that, well, first of all, the dispersion is pretty incredible when you look at the voting members. I mean, I think that's an important distinction, paying a little bit more attention to what the voting members say versus every single Fed official. Of course, what every Fed official says is important, but, the voting members are the ones that are going to actually decide this. But, I was at the Economics Club of New York lunch with Myron yesterday. The focus on the labor market, is certainly real and how much of a deceleration there has been. He was very, sort of focused on the fact that the momentum for labor from the end of last year into the beginning of this year, was certainly slower. We know that via, the preliminary revisions, benchmark revisions that have come out from the BLS. But I think it is the from here, in terms of that labor slowdown, how much of it is going to be demand driven, not necessarily supply driven. That's, I think, where the more dovish crowd of the Fed is sitting and what they're resting on. The more hawkish end, I think, deserves a lot of attention and a lot of credit, whether it's Hammock, whether it's Schmidt, whether it is Musalem, talking about the fact that, inflation has been above target for more than 50 months consecutively. And it's moving in the wrong direction, and it's getting closer to 3%. So there is that really uncomfortable tension between both of the mandates. And I think the next jobs report will probably give, more clarity as to whether this is going to be, more of a momentous cutting cycle versus whether September is more of the exception, not necessarily the rule. But this is just the nature of monetary policy these days, where you have to take it meeting by meeting, data point by data point, jobs report by jobs report.
What's your take on then the impact for the markets as far as that rate cutting or path, that trajectory is concerned? Because, I was just having a fascinating chat with my previous guest, sort of talking about how he believes that the case for small caps as far as sustaining the momentum in the rally that we've seen is much more predicated on acceleration of growth, that, we need to see the economy improving in order for them to continue to march higher. You can take all the rates that you want. They're only going to offer a bit of a tailwind for that. I mean, would you agree with that view?
Oh yeah, growth, I think, is the main driver. Rates can only do so much, especially when it comes to small caps. And for small caps, you really only get that extreme sharp outperformance relative to large caps after you go through a recession and a bear market. And clearly we haven't gone through either of those, I would argue, in an extensive way, especially even with a bear market. Yes, we had a significant pullback. This year we had a bear market for the Nasdaq this year, but it wasn't traditional in the sense that it wasn't elongated, and it didn't go through that entire labor cycle and get driven by major weakness in the economy. Typically, you need both of those components to see small caps outperform. And even in that outperformance window, it is pretty small and it's pretty short. So, catching that is really tough, and nobody can really do that perfectly. From here, yes, I think the growth story would need to improve sharply for small caps. It's just hard to see how that is going to be the case, especially when you do have this deceleration in labor and when you do have relatively persistent inflationary pressure. So both of those are sort of working against small caps in terms of outperformance. They can still do well. I think the Russell 2000, making its more recent all-time high, I think that can continue because momentum is pretty powerful. But looking at it through the lens of outperformance and dominance relative to large caps, I think that's still a bit of a stretch.
Okay, understood. So we'll be watching, obviously, and that leads us to Powell's commentary that we'll be getting this afternoon, which no doubt will set the stage for that PCE data, the Fed's preferred gauge of inflation on Friday, as you highlighted. Kevin, thank you so much. It's been a wonderful chat, as always. Really appreciate your time. Kevin Gordon, Senior Investment Strategist over at Charles Schwab.